Hello and welcome to Livewire Markets. My name is Anna Dadich. As part of our alternative series, I'm joined by Jason Huljich, Joint CEO of Centuria Capital. We are going to unpack what the real estate investment landscape is looking like across Australasia and where the biggest opportunities lie. Welcome, Jason.
Thanks for having me.
So Jason, to set the scene, what are the different asset classes that Centuria looks at and how would you describe the current real estate investment landscape?
Centuria Capital is a ASX 200 listed real estate funds manager. We have about $20 billion worth of assets, and that's split down to about 370 individual buildings and about 2,300 tenant customers. We are split across 7 sectors. So industrial is our biggest sector with about $6.3 billion worth of assets. Then office with about $6 billion. We have about $3 billion of retail, $2.5 billion of debt, $1.5 billion of healthcare. We've got some ag and then we've got some data centres as well. So it's nicely spread. What we're seeing in the markets at the moment, so if you look back the last few years, it's been pretty tough in real estate. Since May 22, we had 13 interest rate rises, so one of the most aggressive interest rate rising cycles we've ever seen, which made it tough for property. Higher interest costs, lower returns for property. Finally, we're seeing some stabilisation. So if you look at valuations, we value all our portfolio every 6 months. So we're seeing exactly what's happening in the markets. For our 30 June vals, across all those buildings, vals actually went up 1%. So we've seen some of the asset classes increasing for the last 18 months, things like industrial, whereas office has just stabilised and hitting the right way. So yeah, after a period of about 3 years of downtime, it's hitting the right way, which is really good. On the leasing side, there's been a lot of leasing activity across the portfolio. So in the last 12 months, we've leased about 520,000 square metres and about 450 individual deals. So putting that in perspective, that's about 2 deals every business day. 520,000 metres, so if you look at something like Chifley Tower, which is one of the largest office towers in Sydney, that's 90,000 metres. So we've basically leased 6 of them over the year. And when you think some of our retail tenancies might be 50 to 100 metres, it's a lot of leasing. So the market's still strong, there's a lot of activity. Leasing has been tougher, but the deals are getting done. You're starting to see that flow through to the listed market. So if you look at the ASX 300 REIT index, so that's 31 real estate companies that are in the ASX 300, for the last 12 months, 26 of them are positive. So there's only 5 that are negative. And so what that is showing is, the institutional investors and the big global investors are flowing into the real estate stocks because they think the cycle is starting to turn. For example, CNI, I think we're number 2. Our share price is up about 45% for the last 12 months. So it looks like the cycle's bottomed out and we're heading the right way.
Okay. So what do you see as the biggest shifts shaping the traditional property sectors?
Yeah, so if you look at office, industrial and retail, and you look at the supply and demand factors. So if you look at the demand side, immigration's the big one. So people think, people moving to Australia, they need homes. So for every 1 million people that come in, and over 2 years, basically 1 million people come into the country, you need 400,000 homes, which what most people think about. But you also need other sectors as well. So every 1 million people, you need about 1.8 million of office space. So that's white collar workers that are moving in, but also the extra white collars to service those people. You need about 1 million square metres of retail. You need about 4.5 million square metres of industrial. And you need about 12,000 hotel rooms. So immigration is a huge demand drive for real estate, not just residential. So you've got this really good tailwind, and we believe that's going to continue. On the supply side, you've had major issues since COVID. So construction prices are up probably 40-50%. So to give you an example, in office, if you look at what it took to build an office building, say in Metro Sydney, pre-COVID, so go back 5 years, it was probably $10,000 a metre to buy the land, construct the building, lease it up. You're all in for about $10,000 a metre. Fast forward to now, because construction costs have gone up so much, it's about $15,000 a metre. Now what that means for a developer is they need to get rents of about $1,000 a metre to make that development stack for them and make a profit. Now, the average rents in our metro office portfolio, we've got one of the youngest portfolios out there, is about $600 a metre. So the economic rent, the rent to make a development stack versus the actual market rent is 50-60% higher. So what you're seeing is forward supply, so over the next 5 years, very limited supply coming into the market because developers can't get it to stack. So what we see over probably the medium term is there's going to be a real supply-demand imbalance. even in office, which has been probably the poorest performing sector over the last few years, over the medium term, there should be really good tailwinds for all sectors.
Interesting. So Centuria also invests in alternative property sectors like agriculture, healthcare and data centres. Why are these sectors so important in today's environment and what role do they play in portfolios?
We were just an office owner up until about 2016 and we made a strategic decision to diversify across different sectors, and it was probably a good decision looking back now. Alternatives was one of the things we went into early. So we got into healthcare about 5 or 6 years ago. We bought a manager called Heathley, which was one of the first groups into healthcare real estate. So they own private hospitals and medical facilities and the like. And we've built that up to about $1.5 billion of assets. We then bought a large manager out of Western Australia that it was in the normal sectors, but also had a small agricultural fund. And we quite liked ag. There weren't a lot of people playing in that space. We saw some really good opportunities. And again, we've grown that as well. And then real estate credit was the other one. So we bought a 50% stake in a real estate credit business 4 years ago, and we've really grown that significantly. So it's good. So about 25% of our portfolio is now alternatives. You can get some really good returns. Most of those sectors are up-and-coming sectors that institutional investors are just starting to get into. So you see a lot of opportunities out there. They're not crowded markets, and if you can get into them early and ride that wave as they become more institutionalised, there's really good returns in those sectors.
Okay, so looking across your portfolio today, where are you currently leaning in most aggressively and where are you having caution?
Yeah, so probably most of our buying has been in industrial and retail. So the latest fund that we put out, which was a very large industrial estate in Adelaide. It was actually the largest ever industrial deal in South Australia. $220 million industrial park, 4 big buildings. We've gone out to raise about $116 million of equity for this fund. It's a single asset fund, and it's been amazing, the demand. So we've sort of had demand for over $300 million of equity for the $116 million. So it's heavily oversubscribed. It's going to be very large scale backs, but it's very interesting to see. It's industrial's definitely been one of the strongest sectors. We've actually had 6 months, 3 6-month periods of valuation growth. So it's one of the sectors that was right at the forefront of the cycle turning. You've seen huge rental growth in industrial. If you go back to COVID, it was the one sector that COVID was actually good for it because it meant a lot more online retail. Online retail needs sheds to store the goods. So you saw rents in particularly Sydney, but around the country, more than double and sometimes triple. Sydney actually had the lowest vacancy of industrial in the world. So Sydney got down to a point of 0.5% vacancy. It's about as low as you can get, and that drove significant rental demand. So we've been buying a lot of industrial over the last 24 months. We'll continue to buy. On the retail side, we've been buying large format retail. We've seen not a lot of supply coming to the market, really strong releasing spreads. So releasing spread is when tenant's lease comes up and either they move out and you lease it to someone else or they sign a new lease. And what is the difference in percentage of the rent they were paying to the new rent? And normally in a normal market, they might be 2 or 3%. We're seeing those spreads up 8% plus. Industrial's been as high as 50%. So if a person was, a company was paying $1 million for their rent of their shed one day, the lease came up, next day they're paying $1.5 million. So obviously all this rental growth drives valuations, right, and drives growth. So yeah, retail, we also had neighbourhood centres. So through COVID, those neighbourhood centres, which might be at Woolies or Coles and 10 or 20 specialties, have performed really well. So we're buying more of those as well. The other growth business we've had is real estate credit. So private credit, there's obviously been a lot of press around it lately. We've seen a lot of growth there. As the banks sort of step back and make it, more difficult for some borrowers, there's definitely a market there where you can get some pretty good risk-weighted returns in that debt side as well.
Okay, and where are you being more cautious?
Look, office is a big one. We've had declining valuations in office for 3 years. We've seen opportunity out there, but we've been cautious when to step back into the market. We've actually got 3 offers out for 3 office buildings right now. So I think we've made the call that it's stabilised. We've seen across our portfolio those valuations stabilise. We see tenant demand picking up, and we can see this medium term supply imbalance. So we think cautiously, there's some value there.
Okay. So can you share a case study example to show how Centuria has been able to identify an off-market opportunity at the beginning of its growth journey and how you've been able to realise value over the cycle of that investment?
Sure. So I think what we pride ourselves on is, being ahead of the curve and finding these opportunities and riding them through. One interesting deal we did about 9 years ago was a precinct it's now called Australian Technology Park, which is an office precinct it's now called South Everleigh. When we got into the market, it was called Redfern. And originally there was a building built out there. It was a government technology park that had never really fired. There was a few government tenanted buildings. Channel 7 built a big facility out there and moved a lot of their team out there. It's now their headquarters for all of their business. Back then it was the TV studios and parts of their business. And the building came up for sale. We went out and had a look, and the park had tumbleweeds going through it. There was just no one around. The location wasn't a great location back then, 9 or 10 years ago. But when we looked at the rents were very low, and they were lower than rents we were getting in Parramatta, Chatswood, and a lot further out. And Redfern Station adjoins the park, and it's one stop from Central, right? So we knew over time this location had to gentrify and those rents had to increase. So we bought that building. Entire building cost us about 200 million. I think peak val was about 450. But what happened very quickly was the government actually put the whole park up for sale. And we bid on the park, which was a number of buildings and then a lot of on-grade car parking, which was development sites where you could build more buildings. We bid with Mirvac, and we did a joint bid. And we took out 3 of the existing assets, and Mirvac got the development side and the old locomotive workshop. And it was amazing. We bought 3 buildings. The total cost was 104 million. What's happened since then? CBA built their campus out there. The whole place has changed. It's a thriving precinct. It's now called South Everleigh. I was out there last week. There's amazing F&B out there. There's pubs. The grounds are out there. The locomotive workshop's been fully upgraded into offices and hospitality. And it's totally different. And we've seen rents move with it. So we've now sold all 3 of those buildings. So that fund's come to an end. So over the 9 years of holding those assets, investors got a total return of about 280%. They had 20% IRR over 9 years. From buying 3 buildings for 104 million, we sold 1 for 20 million, 1 for 116 and 1 for 106. So amazing result, but it was for taking a risk and just seeing a vision for basically an unloved precinct that really had good fundamentals in terms of location. So we do a lot of that type of thing on a precinct basis and then on a building basis as well.
Yeah, I worked in Redfern for many years and saw that transformation happening. It was incredible. So within alternatives, agriculture and healthcare stand out as growing verticals. So can you give us a sense of the kind of assets you're targeting there and what kind of demand drivers that you're seeing?
Yeah, so maybe starting with healthcare. So when we bought the healthcare platform and brought the team across, one of the things they were really focusing on, one of the thematics, was short stay hospitals. So Australia's typically had very large sort of private hospitals as well as the public hospitals. What the team there was focused on was a thematic in the US, which was these short stay hospitals. They're a lot smaller. They might be 30 to 60 beds instead of hundreds of beds. And the whole thing was around efficiency and getting patients in and out a lot quicker. We saw it in COVID, but you've seen it forever. Someone staying longer in hospital means they can get more sicknesses and it's more dangerous, right? So if you can get them out quicker, one, it's more efficient, one, it's cheaper for the government and cheaper for the insurance companies, but it's better for the patient as well. And there's about 10,000 of these hospitals in the US where you might go in for, say, a hip replacement. In the old days, you go to one of the big hospitals in Australia, you'd go in, you'd be in there for 10 days and you stay in for another 10, 14 days to do your rehab. So you're in there for 3 weeks. Very, very costly for the health system. Whereas these hospitals in the US, you might go in for 1 night and then you do your rehab at home. So more efficient and better for patient to get them in and out of the hospital. So we've invested in a lot of those. We've constructed quite a few of them as well. We just opened the first one, a really interesting one down in Melbourne a couple of months ago, which was the tenant is a joint venture between Medibank, the insurer, and 47 surgeons. So they've joined together to be the tenant. So they're working together to bring this more cost-effective, more efficient way of a hospital to Australia. So that's one of the big thematics there. In agriculture, when we got involved with agriculture, we started looking at what was the top of the pyramid, what was the most technologically advanced part of ag, and we looked at very large glass houses. So these are very technical facilities, mainly growing truss tomatoes, and we now own close to 60% of the market in Australia. The operators take very long-term leases, so 15 to 20 years over these assets. So we're not operating them, we're just owning the asset with a long lease. There's a shortage of them in Australia. It's very expensive to build them, and the tech inside them is incredible. You can in 1 square metre, you can grow basically 10 times the amount of tomatoes you can grow in the field, and a lot more efficient on water and things like that. So we've built up quite a portfolio in that space as well, and we'll continue to expand there.
Okay, so real estate debt has been a fast-growing part of your business. What's the opportunity set like today for non-bank lending, and how do you see that market evolving?
Yeah, look, it's interesting. It's been in the press a lot recently. We bought 50% of a business 4 years ago called BAS, now called Centuria Capital, and they had about $230 million of loans out to investors and developers. Over the 4 years, we've grown that tenfold, so it's about $2.3 billion. So we've really ridden that wave of the private credit expansion, and Australia was quite far behind some of the other countries. We were dominated by the big 4 banks. They had 90% of the market, basically. If you look at somewhere like the US, the non-bank lenders have 60% of the market. So it's definitely been growing, but we're still way behind. So yeah, we've really expanded that business. We lend, so about 93% of our book is first mortgage, so we're quite conservative on what we lend to. Only about 7% of the book is mezzanine or second mortgage, and the investors that come into that are very sophisticated debt investors. So our retail and wholesale investors come into the first mortgage product. We lend to 3 types of borrower. So we lend to land bridges, residual stock, and development construction. So land bridges is where there might be a block of land, it's zoned for residential, the developer needs 18 months to get his DA approvals and so forth, and we'll finance that. Residual stock is probably at the bottom of the risk curve. That's when a developer's finished his apartment building or finished his townhouse development, and he wants to keep a lot of them or he wants to sell them down slowly, so we finance the completed stock. And then finally, at the top of the risk, you've got construction development, where someone's building a land subdivision or houses, townhouse development, or apartments. So they're the 3. And we're split about a third, and your returns range on which one you go into. But it's been a very strong growth area. There's been really good returns over the last few years. You can get into maybe a residual stock deal, you might be able to getting 8.5% to 9.5% return. The terms are usually 12 months, so shorter term, which a lot of the investors like, and you're lending, let's say 65% on first mortgage, so quite low risk for that sort of return.
Okay, sure. So going back to what we were talking about regarding the office sector, Centuria recently highlighted momentum returning into the sector alongside ongoing growth in alternatives like data centres and credit. Which of these themes do you think will be the biggest contributor to earnings growth over the next few years?
Yeah, look, I think they've all really got a really good story. As I said, office is starting to turn. You couldn't give it away 18 months ago. We're starting to see a lot of offshore groups come in. What happens in the cycle is when the cycle starts to turn, you see the big offshore groups look at Sydney CBD as a start, and then when that starts to get more expensive, they all go to Melbourne, then Brisbane, then Perth, Adelaide, and Canberra, and the other markets. And we've definitely seen quite a few deals over the last 12 months in Sydney. So you've seen German groups come in, Singaporean groups come in, and others buy office buildings in the city. When we go up offshore to meet all our institutional investors throughout Asia, the groups that are investing into Asia, the top 2 locations are Australia and Japan. China's been very tough over the last 5 years. The developing countries are harder to invest into, so there's a huge weight of capital coming into the country. The Japanese investors are a big one too. They were huge in the 80s, and most of them left and haven't been back. In the last 2 years, you've seen the big groups come in, groups like Mitsubishi, which is one of the largest real estate groups over there. And then once they come in, a lot of the smaller groups follow. So you've seen a huge amount of deals done by them, and they're coming into build to rent, student accommodation, but office as well. And you've seen them come into a number of assets in the CBD. So once you see those groups come in and you see valuations stabilising, we think it's a good time. So you'll see us buying more office, and we haven't bought any office for quite a while. Data centre is interesting. We bought 50% of a business last year, Reset Data, and what they focus on is AI factories. So not your normal large data centre, it might be 20, 30, 40,000 metres, doing storage and basic cloud and so forth. These are purpose-built AI factories, what we call them. We just finished our first one in Melbourne. It's actually the most powerful supercomputer in Australia. We built it on a floor in one of our office buildings down there in Docklands. We're in what we call a NVIDIA cloud partner, so we're a partner of NVIDIA to build out these facilities. Australia is behind on take-up of demand from enterprise, from businesses. We go up to Asia and the US a lot, and it's coming down the pipe, but we are behind. So as that demand comes through from the banks, from the retailers, from government, we think there's a lot of opportunity there as well. And then on the credit side, we think we'll grow our portfolio there by some different products. We'd like to have a listed product. We'd like to have a retail product. All our products at the moment are wholesale or institutional. So I think you'll see growth across all three of those alternatives.
Finally, if we look out 3 to 5 years, what do you see as the biggest risk and equally the biggest opportunity for investors who want to allocate to real estate today?
Yeah. So I'll start with opportunity. It's a really good part of the cycle to invest because, in times of distress, so if we go back, 18 months, 2 years ago when rates were flying up, no one wanted real estate. Yeah, there were some good deals out there. However, are you catching a falling knife? Vals were still going down. Were you going to buy something and then 6 months later it was cheaper? So if you took a lot of risk, there was some reward there. We think the best time cycle to invest is now. So we've seen across our portfolio, we've got real-time data of valuations now stabilising. And it's really the upcycle will commence. So you're getting at the bottom, and it's going the right way. So really good time to buy, we think, across all those sectors. I think what we talked about, that demand, supply, and balance over the next 2 or 3 years will come through in most sectors. So I think there's good value in all sectors. Office, even office is coming through now as well. On the risk side, with real estate, it's all about interest rates, really. So we've had 3 cuts since Feb. The market's pricing in probably 2 more, maybe 1 more this year, 1 early next year. So we're loosening, which is good. New Zealand cut, and we've got about 15% of our portfolios in New Zealand. New Zealand cut, 50 points. So they've gone from 550 to 250. So they've had some serious cuts over the last 12 or so months. And that's all good for real estate. Look, in Australia, my personal view is it'd be nice if the government stopped spending, like a drunken sailor, because inflation's the issue, right? So if they can keep inflation in check and those interest rates stabilise, another 25, 50 points down, it'll be very good for real estate. The risk there is if inflation gets a bit out of whack and we don't get that extra couple of cuts and it heads the other way. But look, our view is probably we will get another probably 2 cuts and it will be a pretty good upcycle for real estate.
Okay, excellent. Thanks, Jason, for sitting down with Livewire today and sharing your insights.
Thank you.
If you enjoyed that interview, give it a like and don't forget to subscribe to our YouTube channel. We release new content every week.